This is episode 204 of the Andrew Hines Real Estate Investing Podcast. Welcome to episode 204 of the Andrew Hines Real Estate Investing Podcast. I've got Cherry Chan on the show again today. Cherry was on the show back in the episode 90 or 92 range. She shared a ton of gold nuggets at the time. We dug into a lot of the nuts and bolts, and this episode built upon that. I asked Cherry what's up, what's new in terms of accounting and what people need to know about in terms of tax filings. And I also talked to her about what's been happening in her personal life and in her investing life. She is Erwin Szeto's wife, and they run their businesses concurrently out of the same office. She does chartered accounting for real estate investors, and Erwin runs the real estate brokerage side for investors. So interesting dynamic they have. They do a lot of education as well with their iWin group, and they recently ran the Wealth Hacker event with Jesse Itzler as a key speaker. So I asked Cherry about that, how that all went, and it was great catching up with her. Just before we get into today's episode, I want to remind you that if you'd like to grab a copy of my cash flow analyzer spreadsheet, you can do so on my website at andrew-hines.com. And if you're interested in seeing me break down some deals in more specific detail with visuals and a visual of the spreadsheet included, I highly recommend you check out my deal analysis show on YouTube called REI Hot Seat. The link is in the description of this video. With that said, if you're enjoying the show, please like, subscribe, hit the notification bell, leave a 5-star rating and review if you're an audio listener. And without further ado, let's jump into episode 204 with Cherry Chan. Hello and welcome to the Andrew Hines Real Estate Investing Podcast. I've got Cherry Chan back on the show. I think you were on the show like episode 91 or 92. It's been a while.
You have really good memories.
Well, the accounting episodes, especially because people ask accounting questions, I'm like, go listen to this episode. So I had to like quote them, and I would always say it's like that. It's 91 or 92.
Thank you.
But I do remember it was a good episode. So I don't think we've talked accounting since then on this show.
Oh.
At least not with a professional accountant. So this will be a treat. And I did just post a story on my Instagram asking people to send me questions, which I'll ask you.
Oh, cool.
Okay. So, but first off, so Erwin's your husband. He was on not too long ago. You guys just hosted another event.
Yes.
Care to tell me how that went and just remind people what it was?
Yeah. So we just hosted Wealth Hacker Conference at the Toronto Congress Center. We hosted about 800 investors in this event, and we had Jesse Itzler, who is a millionaire, actually could be billionaire, because he's
big time.
Yeah. So he was there, and then I was told that his speech was so amazing that many people actually cried.
Really?
At the event.
Okay.
Yes. Yeah. So.
Wow. Yeah, I would have liked to come. I'm still adapting to baby life. Not quite.
Oh yes, I was gonna ask you how's the baby doing?
He's doing well. He's a handful, and and it's like one new thing every day. He's a constant danger to himself, and you know, I'm sure
How
you've been there.
old is he right now?
11 months.
So sleep through the night?
No. But I mean, we wake up like once a night right now.
Oh, that's really good.
Usually. He's actually been a little under the weather. I don't know. He's teething, and you know, there's just one thing after another with him. So
yes, for sure. For the first couple of years, it's tough.
Yeah. So we're getting our groove better. But I have so much respect for parents now, having now been through this. I'm like, I don't know how anyone does it more than once, but I mean, it must get easier. It has to, otherwise no one would ever do it again.
So the second one and the third one, the third one's supposed to be really easy. The second one, to me, I only have experience.
You guys stopped at 2.
Yes, we stopped at 2. Second one was a lot easier.
Yeah. Okay. So, and I hear like they can play with each other, so that'll be cool. Look forward to that.
Looking back, actually, I looked at the parents who have one child. Sometimes I see challenges because they need to keep the kid company all the time.
Always have to.
Yeah. I just kind of like, you guys go play over there by yourself.
You two go in that room, close the door.
Yes. They would literally just do that. Now they wake up and read books. They don't bother us.
That's amazing.
Yeah.
So there's light at the end of the tunnel.
Yes.
It's actually so much fun. It's just, you know, at night it was like we clean up dishes and it's like, oh, bedtime. We're finally cleaned up enough after dinner, and then bedtime. So we're learning slowly.
I mean, I also have a lot of respect for parents who choose to not have a lot of help. So
you guys do have help. That's great. We've been trying. We've had on and off help. We've tried a couple of different nannies, and haven't quite found the fit yet, but we're getting there slowly. But anyways, enough about that. So obviously huge event. You guys are big time entrepreneurs. How do you find the relationship between you and Erwin works, you know, because you're both very big personalities in business, doing your own thing, but also doing stuff together. How does that dynamic work? You guys make a good, you know, business partnership. Do you find you're more independent or more intertwined in what you're doing?
We're very intertwined with what we do to a certain extent, because my practice, my accounting practice focus on real estate investor, and he services real estate investor as well. But his practice has more geographic focus, and mine, I could reach all the way to Vancouver. I work with clients all the way to Vancouver. I have clients that are in Saskatchewan. So his would not have that big wide range. To a certain extent, I have an unfair advantage in terms of marketing, just because in my niche, there are fewer accountants in my niche, so less competition. In the real estate investing agent world, there's lots and lots popping up, right? The competition is so intense. For us, I think it's never easy to have business partner to begin with. I'm grateful that he's there, and he's taking a lot of am I allowed to swear?
Sure.
So he's taken a lot of shit from me. So we're not perfect. We fight with each other. There are tears at times. And I don't want to tell people that we're perfect by any means. So
every partnership has those challenges, right? And those kind of like make you stronger in a way, right? If you can't voice those problems, then that's where you have a problem. Then things blow up, right?
Yeah, absolutely. So, like, I mean, for the most part, we work really well together. He's easygoing on things that he likes to do in his business, and things that I like to do in my business. We just kind of go separate way. But then there are things that we do together. For example, the conference, or we share marketing ideas, and those are really good.
So what about like the options trading? Are you doing that too, or is it just his thing?
So I started off option trading. He started it off, and then I learned, and I did it for a while as well. But then right around the time, maybe 3, 4, 5 months in, I don't remember now, my business actually took another turn. And at the time we didn't work with a lot of realtor at the beginning, but because realtor were allowed to incorporate at that the prac, and as a result, so I was like super busy.
So you stopped doing the options.
I stopped doing it.
And I barely don't really like he's trading for the house anyway, right? So like you can kind of just let him do that, right?
Absolutely.
So you have a good basis of what it is though, and how to do it and all that.
And truth to be told, that really gives us a, I guess, comfort level or enough knowledge for us to handle the accounting side, the tax side of things.
You have a pretty good grasp on how that all works with that. You can advise. That's actually handy. Okay, so you're doing that, and then as far as the event goes, like who handled the majority of that planning? Was it Erwin's baby and you helped, or vice versa?
So actually, it's both. I would say he took on more toward the end. But then toward the very last minute, it's me and my team. So my accounting team are just like all over, like prepping the last minute stuff. But a lot of helping, sponsorship, relationship, promoting the event. Actually, Erwin did a lot of it. Erwin, like, he floats around networks. He does a great job with that. And he's more of the out there guy. Get out there, build the relationships. He does a good job with that. I'm more, if you're familiar with the business model, the EOS model. What's it called? EOS? It's called Entrepreneurial Operating System. Okay. If you follow that EOS model, there is a visionary. Every business would have a visionary, an integrator. Integrator is kind of like CEO type visionary. It's like you come up with the idea and hand it off. Yes. So he's more the visionary. I'm more of the integrator, and then there would be other people. So I wanted to get things done. I feel like I'm more and more leaning towards just be the visionary of things. Like you need to look at your own personality and see how you work. And to me, learning that model really help us structure our business accordingly. Because I don't really enjoy repetition. I don't know. Some people love that. Like for me, like I don't. I mean, I like to get something to the point where I'm good at it and then say, okay, next. Exactly. But I am a little bit of visionary too. So I mean, within my own accounting firm, I am the visionary, and then there's another person that acts as the integrator, and she is amazing at what she does. She always makes things happen.
So you're delegating a lot of your business in the accounting firm. Okay.
The operation, yes, for sure. Marketing is still me.
This episode is brought to you by Control and Compound Financial. They teach real estate investors how to multiply their wealth using infinite banking strategies. For a complimentary wealth coaching session or to learn more, visit www.controlandcompound.com/Andrew Hines. This episode is brought to you by the Investing in the US Mastermind, hosted by myself and Nick Van Dyke. The event is being hosted on March 4th, 2023. We will be starting bright and early in the morning, and we'll be going right through until the end of the day. There's so much jam-packed into this. Nick, what are a few things that people could expect out of the day?
It starts off with like the very simple aspect of like how to buy a property in the US. So we're going to talk about short-term rentals, multifamily properties, self-storage, syndications, which are a big thing in the US. On top of that, you're going to learn like the nuts and bolts of basically, how to open up a bank account, ITINs, EIN, legal structure. We're going to have some accountants that are speaking, lenders on like how to get a mortgage in the US, whether you're going to get a mortgage from Canada or use a lender from the US.
Part of this will be us sharing our experience, the people we've worked with, the connections we've made, because ultimately we want to shorten the learning curve. Both Nick and I have had our bumps and scrapes as we've gone through the learning process here, and we would love to just simplify it for people. If you're looking for more information, head to investingintheus.com. And for early action takers, the promo code EARLYBIRD can be applied at checkout for a 10% discount. Thanks. Now let's get back to the episode. So you're still the voice of the company. Makes sense. Yeah. That and like I would say one of the things I enjoy most is doing this kind of thing, like networking, meeting people, getting out. Like then the rest of the stuff I want to delegate for the most part.
Exactly. Yeah. Well, that's what entrepreneur does, right? Learn to delegate. And the art is hiring people and leverage other people. In real estate world, it's just leveraging the money. In a traditional business sense, it's leveraging people.
Yeah, absolutely. Okay, and your rental properties, is that you handling it, him handling it, both?
We both do different things.
Different things.
So I do the reconciliation. I make sure the rent is collected, chasing after the tenant. He makes sure that the big problems are solved. Like I would know, hey, is the roof really need to be replaced? Yeah. And he would say, okay, yeah, let's replace it. And I'll get a quote. Like, do I know it is expensive or should I look for another quote? He would say, well, like, because he has insider knowledge, right? He's dealing with it on a daily basis. He sees it a lot, So then he would be able to tell me those things. Yeah.
It's a good team. It's a good team dynamic you guys have.
I agree. We have a lot of mutual respect for each other.
Very handy. I'm trying to get Jordan more into like what I do with like the rental properties and like the building in Florida and stuff. Yeah. Like come work with me. We'll do it together.
But sometimes it's not necessarily a good thing. Like I have
it might not be a mesh and but I think it's worth a try.
Yeah, for sure. For sure.
Yeah, even if it's only like little bits and pieces that she enjoys, that would be awesome. Because I think that the cool thing is like spouses have the ability to see their spouse's blind spots, like because you know them. Yeah. Like you would know Erwin's blind spots, the things he might not notice, and vice versa. And that's super helpful. That's
really, really true. Both partners would have to be mature enough to accept that.
Yeah. The critique.
Comment, right? Yes.
The critique.
It is you need to have certain maturity level to be able to accept that.
Yeah. And I think so for Jordan and I, we've been together for 12 years now. I think we're kind of at that point where, we know each other well enough that it's for the most part perceived as well-intentioned.
Awesome. Because I'm still learning. Like to me,
nothing's perfect.
To me, it's really hard to like at time, especially moment of heated debate.
Yeah, heated moments.
Yes, and it's still a learning progress for me.
Yeah, and I say my previous comment, but then also on the other side of it is like when you know somebody so well, she's heard me say the same thing probably a million times, and a lot of it's in one ear out the other. Yeah. Not her fault. I mean, I probably say things repeatedly too much. So, but that is what it is, right? So do you guys find yourselves having that challenge sometimes where because it's coming from you, maybe it's not received the same way it would be from somebody else? Or I guess that everybody has that to a degree.
Oh yeah, absolutely. We have the same problem as every other couple on earth. A long-term relationship. And
when you mix business and home life, right? But I mean, I think that that's better, because why would you want to spend all that time away from your spouse, you know? But then again, some people need that as a refresh. So every couple is different.
I mean, I see a lot of problems people having problems also at work as well.
Yeah.
Like even if they are not working with their spouse, they would still have the same problem.
Yeah, exactly. So got to make it work either way. So
Yeah.
what are the new initiatives that you guys are working on? Like what's coming down the pike right now?
We don't have any new plans.
No new Wealth Hacker conference?
No, nothing in the plans yet.
Okay. Will you do it again? Because you've done it twice now.
I can't tell you.
You don't know for sure yet?
At this moment.
It's kind of like having kids, right? You gotta give it some time.
I know. I have I've got it all out of my system now, and like it is a huge undertaking. Like whether financially or human resources perspective, it's not easy.
Would you say that this one was a success?
I think everyone thinks that it's a success. In my mind, I don't like.
Yeah. So for you though, I think a lot of the people who went probably do think so.
Yeah. So to me, I think we could have done better. Like we still think that we could have done better, and there are things that could have gone different ways, and it's just not done.
Yeah, I mean, you're refining it, right? You've done it twice now. Obviously, each time you're gonna tweak it, grow from it.
So making the same mistake.
You find yourself making the same mistake?
Yeah, pay advertising doesn't work. At least not direct sale.
No, I feel like with that, it's just in the community.
Yeah,
like things like what Erwin was doing. Although he did it closer to the end, he came on this podcast. I think it launched a couple of weeks before your event. Hopefully, you guys got some ticket sales out of that. But yeah, I think that's the way. Really in the community, right? Because they're the ones that are going to be interested in it.
Yep,
and,
absolutely.
like I think my audience is a lot of people who really care about personal development. They're open-minded. Because entrepreneurial mindset requires that. Like you kind of got to be open-minded to opportunities, to thinking about things differently.
So, yeah, absolutely.
And that's exactly what your event would have catered to.
Yeah.
Okay, so very interesting. So yeah, kind of taking it easy. As far as like looking at the market, seeing what's happening, I mean, obviously opportunities seem to be coming. Is that how you guys are looking at this next little bit? Like potentially pick up some more rental properties, or are you kind of cool with the status quo and what you've got?
At the Wealth Hacker Conference, I presented kind of like a plan, like a projection of what people would do. Like I know it is a little bit of reset in the real estate market. I do see opportunities. I see it as an opportunity as well. At the same time, I also feel like I wanted to remind people that, you can choose not to work as hard. You can choose not to buy the next property, even though it could be presented as the next best thing. You can choose not to do multifamily. You don't have to necessarily jump into the next thing.
Well, a lot of people think they do, right? Because they have, it's not FOMO, yes, but also it's keeping up. They want to keep up with the next investor that's showing off the number of units.
Yeah, I know.
I've never been a fan of the people showing off the number of units. Not just because my number of units never stacked up, but just it's all relative. You could be a number of units negative cash flow and underwater.
Yeah,
or you could be a number of units, super positive cash flow and super enjoyable to manage. Yeah.
Well, what I don't want people, or at least I'm trying to use my own voice to influence people, is to invest with an angle in mind, not just like chasing the next big thing. Because it happens. I see that all the time. And now we have lots of clients who come to us and say like, I think I'm going to sell this property. I don't think I can afford it. Or I'm negative cash flow, like $1,800 a month. What can I do? I don't know how long I can last. There are all these problems, not necessarily my problem, my personal problems, but we're hearing it and we're feeling it. And our team feel really bad when we hear all these stories.
So you got these people who bought into cash flow neutral product back when rates were 2%, taking variables, and now they're up at like 6% and they're negative cash flow.
Some of them already knew that they were going to go into a negative cash flow property.
And then it was more negative.
It's just more negative now. Yeah. So to them, it is tough.
Man, that's a tough one. And it's almost like you have to skin your knee to really learn that lesson before it happening.
Yeah.
And I think a lot of people who just never been burned in real estate, because let's face it, for a lot who got in the last 5 years, it's been sunshine and rainbows. Even if you had a bad contractor and had somebody steal your money, you still made money because the market went up so much.
I don't know. I do have one client that's the exception.
Oh, there are exceptions.
Yeah.
I was one of the exceptions. I mean, well, I got burned back in like 2012, but it's a tricky thing that I think a lot of people are going to learn a hard lesson right now, because they did buy into markets like Toronto, speculating on value with negative cash flow. And, you know, it's not a good idea to speculate. Now people are learning why. Yeah,
absolutely. Yeah. And I think there's also a portion of the population that are really capable. They have the money. They may not have the cash flow immediately. The presentation that I did at the Wealth Hacker Conference is really showing, hey, like regardless of what you do in real estate, a lot of the time, the cash flow is not sufficient. Like one renovation, it only takes one renovation, and it wipes out like years of cash flow.
Oh yeah.
Yeah. So all I'm saying is that when my clients come to me and ask me, hey, like how do I protect my investment income? First of all, I don't know why he came to us as an accountant. But I told him, like, you should really diversify in terms of diversifying your income source, not all in 100% in the real estate market.
Yeah.
And you could have some sort of, like, for example, in our Wealth Hacker Conference, we presented the Derek Foster way of investing. Yeah. So high dividend yield stock, and then invest in those. And then there is a steady amount of dividend income that's coming in, which is, yes, it's not as high as 20-30% return in the real estate market, but the cash flow is real cash. The real estate income is, unless you constantly turn over the properties, you don't see the cash flow.
Yeah, well, it depends on what price you bought it, how long you've owned it. I think cash flow's coming back. I mean, I think that there's a deal out there right now that is the cheapest it's going to be. And then there's also a bunch of deals in 24 months time that are probably going to be much cheaper. So it's a potentially a bit of a waiting game for a lot of people, but I think cash flow's coming back in a big way.
You think so?
I do.
I think initially you still don't see cash flow. Like it will maybe 5 years if you were to purchase in the next couple of
Well, imagine buying a building potentially, and it could happen. I mean, certainly on a one-off basis, but a building that would have sold for $1 million for $250,000. Like, I think that that's possible in the next 2 years.
Yeah. That much, you think?
Well, because the effect of the interest rate hikes takes so long to feel, and they've never increased interest rates so much in such a short span. It's going to take 24 months for each one of those increases to be felt fully, I think. This is my sort of arbitrary pin that I'm going to put in. But think about, it's the renewals, the 2017, 2018, 2.1, 2.5% mortgage rates renewing into 6.5%. Where they're like, oh crap, I need to sell, start listing. And then you have the ones that, oh crap, I can't make these payments, start missing. And then they start power sailing those properties. So then we're just a trickle of supply hitting the market. And sure, that'll be offset by immigration. So who knows where that lands. So this is why I give the caveat, I could be wrong about all of this. But on its own, that would stimulate supply significantly. In which supply and demand market, that drives prices down.
We shall see. I'll come on the show again in 2 years and then see, hopefully shorter than 2 years, but I'll see like how it is going to.
We'll do it in one. And I'd love to see the counter argument, right? Like it's tough to pin where the competing forces push the landing spot. That's right, because the competing force, 500,000 people into the country in a year.
So the reality, I think, to a certain extent, I see like people hesitant to buy. Like, I mean, everyone out there is suffering from the cost of borrowing being at the current level. So I see that people are hesitant to buy.
And, very hesitant now.
Even with the higher amount of like historically high rental income that you can generate, it is so hard to find that cash flowing property, at least in the short term.
That's why I think cash flow is coming back, though, because rents, like in London, for example, 38% up year over year on 1 and 2 bedrooms. 38%. That's wild. Offsets a lot of the interest rate change.
Yeah. But then you will be more or less at the...
Yeah. So you're saying it'll just adjust proportionately. Very well may. But my counter argument for that is when you have more properties sitting, there's more chance for things to be overlooked. If there's more inventory on the market, there's more chance that people overlook something. A property with a bad listing photo, maybe listed on the wrong.
There are opportunities, but but I was also told, believe it or not, I have a friend from Yale, and he said that, before this whole interest rate hike, he's first-time home buyer. Before the interest rate hike, I see maybe 4 to 6 listings every week in the area that he's interested in. Now now is 1 in every 10 days, one new listing.
Okay.
So the supply actually drastically dropped as well.
Okay. See supply. Where is this person from?
Toronto.
Okay. So he's seeing supply of new listings come down as well?
Substantially.
Interesting. As you said, we will see where things plan out. Because I like to have this open debate. I think it's important that people think about the factors and make educated decisions and of course be discerning. And I think now more than ever, buy for your fundamentals, right? Buy knowing you're happy to keep that property for a long time if you need to, because you like that property. You like managing that property, or you think you can handle managing it, things like that. Yeah. Okay, Cherry, what's new on the accounting front? Has anything changed? I know you mentioned precs for real estate agents, which I'm sure many listen to this show and probably all decided to get a prec. So that for somebody who's not familiar, that's basically a corporation for a realtor. They never could do that before.
In Ontario. They were never able to do it in Ontario until 2020. So that's not new, but that was a couple of years old.
Yeah, so that was probably existing from back then too, when you were on last time. So that's a huge advantage. They can pay their active tax rate of like 12.5%, is it?
12.2% in the corporation, yes.
That's a lot better than like 50 some odd percent.
Yeah, for sure. If they do careful planning, they could also use the after-tax fund to pay more, to buy more properties in a different corporation.
Right, yeah. So if the structure was done right, if they had a corporation above their prec, you can do that?
Yes.
You can do that. So they could pass dividends up tax-free and then redistribute that and buy properties. That's a cool opportunity.
Yeah, absolutely. A lot of tax deferral opportunity.
Yeah. People just need a good accountant to go over their strategy.
Yeah, and there are more tax changes that's happening.
Okay, so tax changes that affect real estate investors, because I do have some questions, but I will hold on those because I want to kind of go over high level with you first. Yeah,
so there are so many of them. It's not even funny. I actually dedicated the entire hour last night doing a presentation on that.
Oh yeah?
So the first one is the anti-flipping rule. I call it anti-flipping rule. Essentially, the government budget 2022 requires anyone who holds a property that's less than 365 days, regardless whether you live in the property or not, the profit that you make from the sale of the property would be considered profit, 100%.
Active income?
Yeah, business income. So 100%
What about in the
taxable.
corporation? Doesn't really change anything in that regard?
Yeah, if it is in the corporation, it's only taxed as 12.2%. But if it is in the personal name, then it's being added to your personal income.
So for the active flippers out there, this makes no difference because they were already considering it active income.
Exactly.
Yeah, so this is going to make a difference to somebody who kind of played the gray area and lived in it for a little bit and said, this is my home and made money.
Not just that, right? Like I think some investors are trying to file everything under capital gain. Yeah, a lot of you are the sophisticated one. Actually, a lot of people who think that, well, selling a property means that you pay capital gain tax. They don't necessarily think that there is an opportunity. There is a requirement to actually file it as active business income.
Yes, the vultures will come if you don't do it. You know who I mean. I've gotten one of those letters. Hey, we saw that you've sold a lot of properties, and we want you to fill out the survey. And it was the most painful work, like just absolute waste of hundreds of hours of my time. Sending in information and then request on top of request. And I wouldn't recommend going through that. I think, from my experience, the thing that triggered the audit was a lot of it was done early on in my personal name. And that just made me an obvious target. I think the corps are looked at differently. And this is like, I don't know for sure. This is just my thought. And you could probably say what you've seen more of. But I think these probably come a lot more on the personal side for people doing it.
It is true.
And I think because they assume if you're doing it personally, you're not quite as polished as somebody who's doing it in a corp. Probably don't have as many of your ducks in a row and are more likely to be doing things a little by the book, so to speak. Maybe.
Yeah,
maybe I'm speculating.
Maybe. So the reality is since 2015, March 2015, CRA has recovered over $1.2 billion from Ontario audits alone. And then that's the same amount that they recovered from BC audit during the same period. 1.2 billion in Ontario, 1.2 billion tax revenue in BC. So those are a big number.
That's a lot of pain. Yeah. That's a lot of pain for a lot of people.
Yeah, absolutely. Yeah. So like some of these rule changes are meant to essentially clarify. So then there is no confusion. There is no gray area. So that 365 days, well, the same rule apply in the past, whether you live, like whether it is 365 days or beyond 365 days of ownership. Now they just draw a line in the sand.
They just put a hard line on it. Yes. Yeah. They were still going to come after people who did it and reassess them and whatever.
Yeah, exactly. Even if you own it before longer than 365 days, doesn't mean that it's automatic capital gain. So, but right now they just want to make it easier. 365 days and less, for sure you're going to be business, but only for gain. If you lose money, they still go back to the gray area and say like, hey, maybe you are really having capital loss, not business loss. So
I'm just not going to comment on that part.
That's the number one change. The number two change is the assignment fees that you could make from selling pre-construction homes. So in the past, HST would be charged based on the intention. So if you let's just go back. If you enter into an agreement with the builder to purchase a pre-construction home, and then you pay, let's say the home is $800,000, you pay the builder $80,000. Now you turn around before closing, you sell it to someone, a third party, for $900,000. So now the assignment fee is called $900,000, right? But then you pay $80,000 to the builder already, so you also want to get reimbursed by the builder, by the purchaser. So in the past, and up until May of this year, CRA would say, so you need to pay HST on the $100,000 assignment fee. You also need to pay HST on the $80,000 reimbursement from the buyer of your assignment, which doesn't make sense because $80,000 form the original,
was your money.
Original purchase price. So they say that, well, with the new rule change, we don't need to do that. And the assignment fee, if your original intention was to move into the property, then there is no HST charge on the assignment fees. Now they said, doesn't matter now. I don't care. If you sell it on assignment, HST is applicable. There is no going back to gray area. So that's the second change.
Interesting. Does any of this make you want to invest internationally?
So wait. We'll get there. We'll get there. And then the third change, I'm sorry, because I just did all the presentation.
Go ahead. Keep going.
Last night, so it's still fresh on my mind. There's this underused tax reporting thing going on.
Underused?
Yeah.
What does that mean?
Underused vacant home. So it's really targeting foreign investor, right?
Okay.
So essentially the foreign investor, Canadian citizen and Canadian tax resident would be exempted for filing. But right now, the legislation that's being written right now, Canadian private corporation is not excluded filer. So they would still, it's not part of the exclusion. So Canadian private corporation would still have the filing obligation, but they are exempted from the tax. So right now, there is still a filing obligation going on if you own your properties through a corporation.
That's why my lawyer was saying we have to file something.
Yeah.
I never had to do this in the past. What is this?
It's coming April 30th. The form hasn't been even released. How to file it, they haven't known. They haven't let anybody know. There's more.
This must be something else. Yeah, I mean.
Oh, there's another one.
Yeah, that's probably the other one. Yeah.
The other one is not effective yet, so don't worry. It got delayed. So this is trust reporting. So if you think that, well, I don't have a family trust, this would not be applicable to me, that's how I thought too. So that's why I always tune in. Majority of our clients don't use family trust. So I was never really paying attention to the trust update. But this new trust rule that's supposedly to be effective end of this year, but they delayed it. About a month ago, the draft legislation just got released, first draft. So they decided to delay it to become effective next December.
Okay.
Now, so what happened is that if you use a trust agreement to purchase a property in trust for a corporation,
okay,
then you have that trust reporting obligation.
Okay.
So now you have to file a trust return every single year. For that trust, every time you have a trust agreement. So every trust agreement is an individual trust that you set up. So you have to do that filing.
Is it like, do you know how significant of a filing this will be yet? Or is this like, it might just be a one pager, or this actually will be a significant return?
It could be simple, but it still costs a filing, like cost of maintaining the business, right? But to a lot of people who purchase properties in their own name and have corporation really report all the income, expenses, assets and liabilities, this could be huge for real estate investors, right? So if you have joint venture, that would be also a trust. And this, as of right now, the legislation that's being written, this whole trust reporting also cover a situation where an elderly mom adding the son into on title for their home because she's getting older. She wants someone to take care of the administrative work. But the son is really on title just to deal with this paperwork. He doesn't really own the property. The mom is still the true owner. So that's still a trust relationship. Yeah. And that type of relationship would still require a reporting. And this is current. And it's not
at the end of the day, if you got a good team, like a lot of this stuff doesn't need to be a big deal.
But there's still cost.
It's beyond annoying.
Yes.
I'm sure people know my personality with this stuff enough. I won't elaborate beyond that. But so obviously those are some of the changes. Is there more like that's right on kind of the tip of your mind here? Top of mind?
So a couple more, but those are minor ones.
Those are so these are the big ones that's going to kind of change what it costs to do business in Ontario and in Canada.
Yeah. Also, US also has some reporting requirement that's upcoming if you have US corporation, and still requires you to do additional reporting in terms of beneficial ownership and all that. Yeah, so that is also coming. Like, it's not just a Canadian thing. I think the USI has also started the same thing as well.
Okay. And do you have like, what do you do with your clients that are investing in the U.S.? Do they have somebody? You have somebody that you refer them to that handles the U.S. part of the business?
Yes, right now we do. Yeah.
Okay. Yeah, because I know some of the questions I received were U.S. related. Just people wanting to know some of the stuff and the implications. Just on that note, because I think I remember the nature of the question, implications for people who own U.S. property. I mean, I know you have to tell them if it's over $100,000.
It's more than that.
And there's a lot more than that.
Yes.
I mean, I let my accountant handle this. But I'd love for you to tell it in detail.
So from a Canadian tax perspective, depending on how you own the U.S. properties, and not just U.S., to be honest, like people nowadays invest everywhere, like Costa Rica. I have clients investing in Europe. So so anytime that you own the property in outside of Canada, or any investment outside of Canada, that's over $100,000, you Canadian, you have to report it on your return. And as Canadian tax resident, you're also required to report worldwide income. If you receive income from that property and net of expenses, you have to report it accordingly. So those are pretty much the minimum. Now, if you own your investment or your properties via a corporation, you're supposed to report that corporation ownership on your tax return.
Right.
So if you have a Canadian corporation owning a U.S. corporation, your Canadian corporation is required to file the form to report that corporation's holding And then also if the corporation invests in property and generate income from properties, then you're supposed to also report it on the Canadian form.
Yeah.
And tell Canadian government that, hey, like I pay this much tax in this US corporation. And then
you get a credit for it.
You get a credit.
If you do it right. Like there's ways to do it wrong and you can't get the credit.
Yeah. And then afterwards they would bump up the tax if you don't pay enough.
Yeah.
So they...
And odds are, like for the U.S. relationship, you're probably not going to pay as much tax in the U.S. as you would, if you did the same calculation in Canada. So it's like you're going to pay a portion in the U.S. and then pay more in Canada. But it'll be like they'll calculate the difference.
Yeah. The complication comes into different roles and different entities. I've seen clients who come to us and ask us, oh, I wanted my U.S. lawyer wanted to set up this LLC.
They want the
thing.
LLC, which is just don't do that. I'll just say that for now. Don't do that.
Yeah, and then people would come to us like, why are you telling me not to do that? Why do you want me to set up this LP structure?
Yeah.
I don't understand. This is so much more costly. And I'm like,
way more costly, way more complicated, but it from CRA IRS relation, you get the tax treaty benefit. Otherwise, with the LLC, you're going to pay taxes under the LLC and get no credit for that in Canada, is my understanding.
Yes, absolutely.
So unless you want to be double taxed, don't do that. But I mean, yes, I've heard so many people, set up the LLC. Well, I guess you'll just have to convert it into an LP.
Yeah.
Or do a new one.
Yeah, absolutely.
Yeah. So, that's definitely a good point to make. I made the mistake first time I went into the States setting up the wrong structure. Thought, hey, I'll do this. I don't know why. I was very naive. But yeah, of course, talk to the right expert. Yeah. Talk to somebody who knows, make sure you're set up in the right way.
The thing is, a lot of people just go to the States, and there are states has a lot of opportunities, but then the people that work there only know the state side.
Yeah,
they don't know dual.
Oh yeah, you talk to anybody down there, they'll be like, "What are you doing with an LP?"
Yeah,
like I'm the weirdo with the LP in Florida.
Yes.
Like, why do you have this? Like, why? Like, the lenders are asking, I don't get it. Why? I'm like, it's for tax treatment. Just chill. I'm the only owner of it. Like, they want, who's the partner? It's me and me.
Yeah. I know. It's hard to understand. Yeah.
I draw it out for them, even though it's really simple. So there are, I would call those hoops to jump through. I mean, when people ask, like, what are the implications? Yes, there's obviously more to discuss, but at a high level, that's something to consider. Although that's not for everybody, because some people want to own with a corporation, and then maybe an LLC would be appropriate.
It gets more complicated.
Or a C-corp.
C-corp.
Treated like a C-corp is what you would want.
Yeah. C-corp. And there are times and place for that, but you just need to understand the ins and outs. I work with an investor, and we just recently helped her set up some structure, and it came down to, hey, like, the best way to own it, she has specific reasons and objective. The best way to do it is really have a C-corp directly owned by her. Typically we don't do that, but there are certain objectives. She's planning to move to the States. Like, everyone's situation is a little bit different, so the advice would be different too.
Right. Yeah. If you were immigrating, depending on when you knew you were going to be there, and if you weren't going to be coming back to Canada, then you might not worry about that tax treatment in Canada. Yeah. And then of course, like, I think the big one, and I know somebody, I'm not going to name drop, but he wanted to take money that he had in his corp down, so he used his corp to buy shares in a corp
exactly.
There,
That's
right?
also plays into the role as well, right? Like, some people are just like, you're wrong. Like, you said that people said that you could do LLP, and I'm like, well, first of all, LLP in the States are really only for professionals.
Yeah, you wouldn't do that.
Yeah, so like, people don't really understand.
That's what I did. I'm like, I want limited liability. I don't want the limited partnership. I want a limited liability. Yeah, that was stupid. That was me, circa 2012. Oops.
Well, you made all the mistakes, and now you're on the right track.
Yeah, second time around, I knew better. Yeah. Yeah. Okay. So yes, exactly. Don't assume anything with any of this stuff.
Yeah. Absolutely.
Pay for good counsel.
Yeah. Absolutely.
Is the way I would suggest that.
I think one thing that I wanted to caution people is that I think it sounds like you've invested in the US for a while.
Yeah, second time around, started again last year. But first time 2012. Yeah,
so I just wanted to caution people on foreign exchange currency, foreign currency exchange risk.
Yeah.
I know those are big terms. I used to be responsible to report the gain and loss on these contracts. I could see that your son is playing.
Oh yeah, I'm sorry, it's not you.
I know. I would not take it personally by no means.
Yeah.
But I know my topic is drive.
I think this is really valuable.
So the I have a client who was considering doing something bigger in the States, wanted to raise fund and buy apartment buildings in the States. And I said to her, the first thing I said to her is like, you have to consider this foreign currency exchange risk thing, because right now it's 1.4, close to 1.4, less than just
1.35-ish.
Yeah. So like, you really need to think about, hey, your dollar is not really a dollar over there. Yeah. But people don't usually think about that.
But how are you thinking of the risk? Because I think, a big risk would be the volatility if you borrowed here to buy something there and then, say change swung enough that you couldn't pay out your loan. That would not be good. Like those are kind of some of the things I see as a potential risk. Are you thinking something beyond that?
Yeah. So, all of our initial capitals would be Canadian, right?
Yeah.
So, whatever your initial capital, the bigger the initial capital taken from your Canadian dollars to US dollars, the bigger the risk, right? So if you have less initial capital, then your foreign exchange exposure would be less. The reality is not about paying down the mortgage. If, depending on your investment horizon, if it ever goes back to 1.2 or even 1.1, I've seen people on paper, on US dollar side, it makes money. But once it's converted back to Canadian, they lose money. Yeah. I've also seen people who made close to nothing, but because of foreign currency exchange, and they bought it close to early 2010, then they made money because of foreign currency exchange, right?
Yeah, absolutely. Yeah, I was, some of the stuff I moved over, I don't remember. I got better rates than it is now, low 1.2.
So you actually made money now if you converted everything
unrealized,
back.
Unrealized, but for sure.
Yeah.
So let's go through some of these questions, because there were others, and I imagine some of the answers are going to take a little while, so we should get into them. So what's the best route to take when looking to start a corporate structure? I mean, I think there's so many additional follow-up questions that need to be asked there.
Yeah, absolutely. So there are like 6-7 questions that we routinely ask our clients to come in for consultation to decide whether they should set up corporation or not. What are your investment strategies? What are your investment horizon? What are your bigger goals? If you're buying only one property and it's a condo, single family home, may not be worthwhile. Where's the money coming in from? Some people have businesses to begin with.
And if you don't want to take it out personally.
Exactly.
So there's a lot of follow-up questions that need to happen.
I know. Not that I want to dodge your question.
No. I'm calling that out right as I see it. So this just came in. So I would 100% agree. I also had somebody, and it's a related question, who asked, when's the right time to stop buying properties in your personal name? And I think that's a dual answer between your mortgage broker and your accountant.
Yeah, absolutely.
Your mortgage broker is probably going to tell you it makes a heck of a lot more sense to start building in the corp early. Because it's going to weigh you down. Like, say you want to go buy your own home and you've got 20 properties in your personal name. Good luck.
Yeah.
Versus you sell all those properties to a corporation. Now all of a sudden you're back to scratch.
Yes, you are. You don't have any liability in your name. The reality is that I hear a different story from mortgage brokers.
It depends. Like,
they would.
It depends on the lenders they work with. A lot of brokers can't work well. I mean, in the broker world, there's like only 1 or 2 lenders that. So TD will still work with brokers, but it's not the same treatment as if you worked with a mobile specialist. Scotia will work with brokers, and I believe
in
National
the corporation
Bank.
Too? Scotia?
Not with the corporation. So you can close a property in a corporation if you work with somebody that directly works for Scotia. But if you go through the broker, you can't. And so there's not equal treatment. So I think a lot in the broker world is they'll speak from the paradigm that, of who they have access to. So it does skew the answer. And I like to call that out, coming from that world, is that you do have to understand that if a broker can't get paid from a certain option, if they're not willing to charge you a fee, they may just not even tell you that option.
I have a broker who worked with one of our clients, and we said that because the client has big plans to buy like 10 properties. So I said, like, you should set up a corporation because you have the plan to buy 10 properties. Set up the corporation, went to the mortgage broker. The mortgage broker said, like, why did you set up a corporation? Your accountant just wanted you to set up the corporation to make the money. And like, I was so upset at the mortgage broker.
Depends on the goal. Like, what's the goal? Like, if your goal is to acquire, 20 properties or go past 10 even, like even past 5, you're going to start having trouble at 5.
Yeah, exactly.
So if your goal is to go past 5, I think give it thought. Talk to your accountant, talk to your mortgage broker. But I think that's, if your plan is to go there, then you might as well get the corps going early.
Yeah, absolutely. And then people often have this misconception that, hey, like, people say that, oh, I don't realize any tax benefit until I have 2 or 3 properties. And so I will wait until I have 2 to 3 properties before setting up the corporation. But the reality is, you need to have those 2 to 3 properties inside a corporation. So, and then by that point, like, you may just want to buy 1 more or 2 more. Then is it worth it? Like,
well, I mean, I think to a degree, and we talked about this before, I think last time you were on, you pay a higher tax rate in the corp, but then if you pay a dividend to yourself, you get a credit back. So it works out to be about 20%. Whereas people are, doing it personal income, you're paying it at 50%. So, but in the corp, 50% can be hard to swallow.
You don't really pay it.
You don't really, as long as you dividend yourself something.
You also pay.
And you can do capital cost allowance to write down your income. There's a lot of things you can do. So I think here's the takeaway I have from it is people who grow big use corps. Like, that's just a fact. So, take that and use that as you will. Okay, so there isn't a right time universally. I think it comes down to goals. There's a bunch of qualifying questions. Just the classic, when should I incorporate? Oh, same thing. Okay, we're not getting there. We're not doing that again. Is it worth it? The accounting profession, only half joking.
So is it worth to...
So somebody's asking you, was it worth it going into the accounting profession, I guess?
100%. But like, I don't know what kids these days, I don't know who was asking that questions, but what whatever you do, you don't stop your education and stop there, right? Like, you progress from there and become a different person.
When you're probably constantly growing in your profession and learning and like changing. Okay. So charging HST outside of Ontario. This is actually a relevant one to me too. My understanding is that if somebody has no presence in Ontario, like somebody was in Montreal or Quebec, then I would only be required under like HST rules, I would charge GST.
Yes.
If they have no Ontario presence.
Yes.
Okay.
Yes. So I think it goes a little bit beyond that. I actually just went through a PD course on GST and HST. GST and HST, by the way, follow a different tax act. It's called Excise Tax Act. So it's not Income Tax Act. There are specialists who work just with Excise Tax Act as well. So the reality is sometimes it depends on your presence in the other provinces as well.
Yeah, if you have a presence there too.
And then if you're doing Amazon business, the distributor, then it's a different level of charging. So it gets a little bit more complicated as well.
Okay, so I just gave the really simplified. Okay, so talk to your accountant is the answer there.
I'm so sorry.
No, I appreciate that. Like, there's nuance. So as I would expect. So we already talked about tax consequence of owning U.S. property. Didn't really sound so much about a consequence. I think the biggest consequence is needing to file in the U.S. It's also extra fees. What's that?
Also in Canada too, right?
Yeah, you got to file on both sides for what you're doing. You have to keep track of it in your books. Like, there's things to do. This is a good question. How to offload things to a bookkeeper? Like, what do you tell your clients?
A lot of our clients are smaller. They don't. And sometimes they do. I think the best thing to do before you do anything is to have your own, I'm going to swear again, have your own shit organized. So, and going through like, if you own your properties in your personal name, have it all in one, at least multiple bank accounts or one bank account for one property, that kind of thing. It makes your whole offloading a lot easier, a lot simpler.
Keep your stuff in one account. Try and have like a QuickBooks Online or equivalent. And actually use it. I think the first step is really to have that system set up. And you know where the money comes in and goes. And then when your bookkeeper
take over, the simplest form is to give them your bank statements, and they would be able to create the books for you to probably 90% of the time. If you have any other cash extra expenses, then you will have to give the receipt to them.
So I'll give some tricks that I have sort of learned. I have, so per corporation or whatever, an email address. Any invoices that come in, they go there. My bookkeeper, so say for our camp, he goes in and he logs into all our different platforms, downloads the data, gets the invoices and matches everything up, and then stores it in a Google Drive for me, like the actual PDFs. That's sort of, and I think like the feedback I've gotten is that we're like, you know, goals level of organization. I'm not that organized everywhere, but that's in that specific instance. And I knew just because of the number of transactions, we couldn't play around. We had to be very on the ball with what we were doing.
Absolutely.
But the smaller ones, I think people get the feeling that they can play around a bit because there's not that many transactions. It's amazing what 8 months will do when you're trying to think of what something was and you can't figure out what that invoice was.
Sometimes it's a couple of years.
Oh yeah, that's even better when that happens. Let's just see if there were any other questions. Unfortunately, I didn't think to put this story out until a little bit more recently. Oh, no, there's a bunch more. Okay, so HELOC use, tax implications, interest payments, deductions. Oh, the Smith maneuver. People make that into such a big deal. If you're borrowing money for an investment purpose, you can write it off. Is that a fair assessment?
90%, yes. So you have to qualify that investment as a taxable income. If you have to earn taxable income. So if it is purely invest in something that would generate capital gain, then the interest is not tax deductible. The other thing is that people also would ask questions such as, like, if I borrow money to contribute my TFSA, well, to them it's still investment, but the reality is because it's TFSA is tax free. So again, interest is not deductible.
Okay, so but from a rental property standpoint, that's a pretty standard thing. People will borrow a portion. I think the big thing that you would probably tell them is, you know, separate it as a separate portion of your mortgage. Like use like the Scotiabank step where you have a portion that's specifically for that. And well, some people refinance and then the bank would tell them, why don't you merge the two together? And the follow-up question to it is the portion that was originally HELOC, you can still prorate your interest deduction accordingly. You just need to do the proration. You have to do the math. I have some that I've done the math like that before I knew better. So you can do it that way too if you keep track. Okay, so I won't be able to go through all of these, but what was another one? There was another good one. Oh yeah, property in personal name but renting it on Airbnb. Does it make sense to open a corp for the Airbnb? Can that be considered active income, an Airbnb? It's hospitality.
So so this is a huge topic. The reason is because if you rent out a property on Airbnb on short-term rental and you do it consistently and you're not using it as your personal residence, or you don't do any longer-term rental, on the sale of your property, you not necessarily on the sale of on the sale of your property, or on at the moment when you convert it back to long-term rental or convert it to personal use, there is HST implication.
Yeah, and that's a super, super concerning, very damaging implication. So, and I've heard that some accountants have a workaround on this. In your opinion, is there a valid workaround on that?
I kind of know what the workaround is. I think if CRA really digs into it, I mean, we do the workaround. It's just that if CRA does really look into it and look through all the corporate structure. So your corporate structure might be to have a separate corporation that's actually doing the renting. So that separate corporation might rent the property on a monthly lease. Yes. Yeah, that's sort of what I figured was the workaround. But then is it a truly workaround?
There's not truly arm's length. So then they would say, oh, still.
Yes. I mean, I always advise my clients there's that risk. What they do is up to them.
Okay, so I had told somebody I would ask this question, so I gotta make sure I ask it. Okay, I'm a new real estate investor considering my first transaction, considering JVing with various components of the transaction per an agreement. Where I'm not clear is how taxes are typically treated on capital gains. Whose responsibility are they? How are they typically handled when a property is sold? And what is your experience?
So our experience is that it goes back to that JV agreement that they sign. It really goes back to how they split the money. So if it's that person's first deal, if it's possible, I would not try to do that JV thing. Initially, for your first one, you do it on your own. But if you do if you are the one that, hey, like I really do need those help, like qualifying for financing and all these things, and you don't have a choice, then you would have to navigate through all these hoops. So in a typical, let's use a really traditional, the typical joint venture arrangement. Let's say I'm the sweat equity partner and you're the money partner, and we agree to split the cash flow 50-50. We agree to split all the cash 50-50 upon sale in 5 years. So the very traditional type of situation. So 50% of the gain will be reported by me, and 50% of the gain will be reported by you.
But how is it a gain? Oh yeah, I guess. I was just going to say, like, the sweat equity partner doesn't actually put any money in, but can still have a gain, still reports the purchase at a certain level and reports the sale. It doesn't matter how they financed it, debt or Well, joint venture deal is not necessarily at the smaller scale that we have, right? It's very common in the real estate world, like whereby one person, typically the landowner, they would be the one that's contributing the land, and they don't want to necessarily pay the land transfer tax on fair market value to sell it. And so what they would do is that they would then form a joint venture with the actual builder, and then they together do their division of profit and everything. So it goes back to what your joint venture agreement says. Like maybe the day-to-day, I keep all the profit because I do all the work, and it's not a lot of money. You don't care if you get any of the cash flow during the rental period, the ownership. So then I report 100% of the income and expenses. Okay,
on a regular. It goes back to that too.
So yeah, keeping it simple. Look at what it says. You're going to need to be reporting whatever based on whatever it says. But of course, talk to your accountant to make sure that you're reading it correctly. I can see what you're getting at. The reason not to do it is, that's a cost to pay your accountant to make sure that everything's in line. And
then sometimes some joint venture agreements not that well written.
Well, that's the other thing. Go get a lawyer who does it all the time, and
or they are super well written, all in this lingo,
that
legal
you can't understand.
Exactly.
No, it needs to be like legible, like layman's terms. Obviously there's a lot there. Okay,
so there's wide range.
Okay, anything else before we wrap up that you wanted to touch on?
No, I think we cover a lot.
We went over a lot of key topics, kind of surface level, and I think gave people some perspective, and from there that they'll at least have a direction of what they should ask their accountant.
Absolutely.
Okay, perfect. So where do people find you, reach you, follow you?
So I do a weekly blog post, and you can sign up on my blog, specifically related to real estate tax tips, and the website is realestatetextips.ca.
Real Estate Tax Tips. Is that your YouTube channel as well?
So yes. So my YouTube channel, I'm on YouTube. So we do release video once a week, and it's youtube.com/real estate tax tips. And I'm also on Instagram. It's also
Real Estate Tax Tips.
Real Estate Tax Tips.
All right, so that's easy to find.
Yes.
People will remember that. That's good choice of handle.
And for the old folks out there like me, old folks that still use Facebook. It's facebook.com Real Estate Tax Tips.
I thought you were going to say like in the yellow pages.
No. I had like my friend's son, 14-year-old. He literally said that, so for old people that use Facebook. And I'm like, what? Yes.
I find myself not really using Facebook anymore. I don't know. I you know what? My happy place is, with my phone not next to me. so I think I just more as I age, I just get lean to that direction. But anywho, okay. Well, thank you very much for coming over, Cherry, again. And it's always great to have your updates and your insight. And we'll definitely keep them coming, and we'll get let's not let it go 2 years before we get you back here.
Yes, I need to come back so that we can reevaluate the market. Yes,
we'll have to see. Hey, where did we land?
Absolutely.
Okay.
Well, thank you so much for having me.
Thanks for tuning in to today's episode. Please make sure to share this episode far and wide. Help more people. I really appreciate you tuning in. I'll see you on the next one. There are a lot of people out there talking about the infinite banking strategy and whether or not it makes sense for them. To find out what it's all about and if it's a fit for you, visit controlandcompound.com/Andrew Hines, where my audience can gain exclusive access to books, podcasts, and webinars tailor-made for real estate investors. This episode is brought to you by the Investing in the US Mastermind, hosted by myself and Nick Van Dyke. Nick, let's talk about why it's so important to network with other people who are doing what you want to do.
You're the average of the 5 people that you hang around with. So when you go to events like these and you network with people that are wanting to do big things in their life, generate more income, wealth, more time, all that good stuff, when you surround yourself with those people, you just automatically now want to essentially replicate that.
And there's so much that can be accomplished by going to meetups and things like that, and those are all great. But when you focus in on a mastermind, these are people who are willing to invest in their education. They're determined to see an outcome, and it's a like-minded outcome with what you're looking to do. Our hope is that you're going to have an opportunity to speak with everybody who's in attendance, get to know what they're working on, and that's why we're starting early and we're going right through to a dinner that we're including in the event to give you a chance to actually have those conversations. If you're looking for more information, head to investingintheus.com. And for early action takers, the promo code EARLYBIRD can be applied at checkout for a 10% discount. And we'd love to see you there.